It's great to have you. I'm very excited about our conversation. It's been about a year and a half since you came on, and we're optimistic and we're proven right in what was at the time a rather pessimistic period. Well, the tables have turned. Things are optimistic now. So optimistic that we have the stock market kind of going gangbusters, NASDAQ hitting new highs every day, it seems, NVIDIA off in the stratosphere somewhere, and other AI chip names following along. And therein lies the problem, potentially. I'll let you take it from here.
Yeah, I think when you think about trading markets, the most important thing is to think you have to start with what's priced in and how people and what people's expectations are and what expectations are priced into assets. Um, and you know, the contrarian podcast is perfect in that sense because in order to generate alpha, you have to be contrarian to whatever that expectation is, right? And so if you look at what's priced into asset markets today, particularly if you look at what's priced into stock markets and growth expectations, they're very elevated. So we had this long period, as you mentioned, where people thought that we were going to, continuously think that we were going to go into a recession, go into a recession, go into a recession. Well, basically over the course of the last 3 or 4 months, that has totally been wiped away. And now expectations are for the US to be basically as strong as it's been over the last, 2 or 3 years, for that to continue essentially out for many quarters into the future. So, for instance, if you look at economists' expectations, which are not a perfect measure, but a pretty good indication of what's going on, they're for 2024 growth to be at 2.5%. Well, we already know what the first quarter was, 1.3%. Okay, well, that means that the rest of the year has to be at 3%, 3% real growth. 3% real growth for the US economy is very, very strong. That's going gangbusters. And on top of it, you look at earnings expectations, and they're pricing in 17% earnings growth year over year by the fourth quarter. Again, is that possible? Sure, it's possible, but that is very, very strong in an economy that's only growing at sort of 5 or 6% on a nominal basis. And so you put that all together and you say, look, the economy, the expectations are very, very high and reflective of that sort of backward-looking strength that we've had. At the same time, you could think about, the higher rate environment, and the continued sort of the continued challenges, that weigh on the economy. They are slowly but surely degrading the economy, right? Slowing the economy to some extent. So you have this weird dynamic where, as the economy is likely to slow ahead because of what has happened in the past, expectations are basically as strong as they've ever been.
Yes. Now, but what can slow up the economy? And are there any cracks in the foundation? Today we had consumer confidence blow away expectations. That's just one gauge, and it's just a survey, but right, I think whatever. But where could are there any cracks? Where could they develop? What is there to indicate that the economy is going to slow this year, or at least not continue its breakneck? Are we talking about breakneck growth already? Whatever the growth is.
Yeah, well, it was close to breakneck growth
Yeah.
in 2023. And so I think most of us in our professional careers have seen basically cycles turn down very rapidly, whether it was, the 2008 crisis. Obviously, COVID was a shock. It was very rapid. Or even the 2000 cycle, was a bit of a abrupt drop as the tech bust started to get going. And I think most of us haven't experienced what is sort of like traditional cycles, are ones in which interest rates rise as, the economy strengthens and gets too hot, interest rates rise. And then kind of, it's like death by 1,000 paper cuts, there's one company and the next company and the next company that struggle to roll over their debts, or their financing costs a little too high, or they don't quite need to do the investment that they expected to do at current yields, and so that has second and third order effects. Or housing doesn't crash, but it kind of meanders to slowing down, and that's really what's going on. So when you think about the economy right now, it's like, where are the cracks? There are no cracks, meaning cracks in the sense of chasms that will plunge this economy into a rapid deceleration. But instead, what we're seeing is just chinks in the armor every day coming in and seeing the next thing and the next thing and the next thing. And so when you look at the data, what you see is, for an economy that is very income driven, we've seen employment go from, 500,000 jobs a month to 250,000 jobs a month to, if you average the household survey, as well as as well as payrolls, you got something that's closer to 150,000 jobs a month going on right now. That's a deceleration. You see wages, they were 5.5% growth on average hourly earnings and 4.5%. Now we're in the high threes. That's a deceleration. And so that's the type of dynamic I'm talking about. One in which if you squint at every data point, individual data point, you'll lose track of the fact that we're gradually decelerating. But it is true. We are gradually decelerating in the US economy, and that's likely to persist as long as interest rates remain elevated.